Welcome to Hibiscus Petroleum's Financial Results webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 31st March 2023 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad or the company solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today is split into 3 parts. Part 1 of our presentation presents our key messages and highlights for this quarter, which will be presented by Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, a wholly owned subsidiary of the group. Part 2 covers the group's quarterly operational and financial updates and will be presented by our VP of Economics and Business Planning, Deepak Thakur, and our Chief Financial Officer, Yip Chi Yong, or CY. Guidance on our offtake schedule and gas sales will be presented by Deepak Thakur in Part 3. Should you have any queries, you may contact our Investor Relations team headed by Lily Ling, our VP of Corporate Development, via the email address provided at the end of this presentation. Now over to Pascal.
Hello, I am Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, or HML. And here are our key messages for the current quarter. Continued strong oil and gas prices have positively affected the group from a financial results perspective. In the current quarter, we sold approximately 1.1 million barrels of oil and condensate. Gas was also sold, which amounted to 0.7 million barrels of oil equivalent. For the financial year to date, we sold an aggregate of 5.4 million barrels of oil equivalent, comprising a total of 3.5 million barrels of oil and condensate and 1.9 million barrels of oil equivalent of gas. Going forward, the group's target for financial year 2023 is to sell approximately 7.2 million barrels of oil equivalent of oil, condensate, and gas. In the current quarter, our average net oil, condensate, and gas production exceeded 21,000 barrels of oil equivalent per day, with Peninsula Hibiscus Group assets accounting for 65%. Year-to-date, normalized earnings before interest, taxes, depreciation, and amortization, or EBITDA, and normalized profit after taxation, or PAT, stood at 947.9 million ringgit and 301.6 million ringgit, respectively. In the current quarter, we delivered an EBITDA of 291.6 million ringgit and a PAT of 71.5 million ringgit. This represents an increase of 80% for EBITDA and 104% for PAT compared against the normalized EBITDA and normalized PAT recorded in the financial quarter ended 31st March 2022. In March 2023, HML completed the longest well drilled in Malaysia at the Bunga Orchid field in the northern area of PM3 CAA. The well, Bunga Orchid C29, was drilled to a total depth of 6,963 meters and produced at an initial rate of approximately 4,000 barrels of oil per day, exceeding initial expectations. For prudent reservoir management, the production rate from the well is currently being maintained at about 3,000 barrels of oil per day. The well was drilled utilizing the PVD-3 drilling rig and is the 5th well and 2nd oil producer drilled as part of the 6-well Bunga Orchid H4 reservoir infill drilling program. We received a Focused Recognition Award from Petronas in April 2023 as acknowledgement of this achievement. The continued consistent financial performance of the group has allowed us to reward loyal shareholders. As previously disclosed, based on the present favorable market outlook and subject to matters reflected in our dividend policy, the group is aiming to target a minimum total dividend per share of 2.5 sen over the course of financial year 2023. Of this amount, a second interim single-tier dividend of 0.75 sen has been declared on 24th May 2023, bringing the total dividends declared to 1.5 sen per share. Overall, we are pleased with the progress and performance of the group. That's all from me. Now on to Deepak for the operational updates.
Hello, I am Deepak Thakur, VP of Economics and Business Planning. Let me bring you through an overview of this quarter's operational highlights. This table shows the operational performance of our North Sabah, Anasuria cluster and Peninsula Hibiscus group assets for the current quarter ended 31st of March 2023. Focusing on the North Sabah asset, the production facilities recorded an average uptime of 95%, higher than that delivered for the preceding quarter. Average oil production of 4,704 barrels per day was fairly consistent when compared to the preceding quarter. Almost 300,000 barrels of oil net to sea hibiscus was sold at an average oil price of $83.02 per barrel in the current quarter, representing a decrease of 15% when compared to the preceding quarter's realized average oil price. Over at Anasuria, the average uptime of 96% was higher than the preceding quarter, while average daily oil equivalent production rate achieved of 2,699 barrels of oil equivalent per day was lower. Production in the preceding quarter was higher due to flush production from wells that were previously shut in due to the riser failure. One crude oil offtake was conducted at Anasuria cluster during the current quarter, in which approximately 203,000 barrels of oil net to Anasuria Hibiscus UK was sold at an average realized oil price of $74.81 per barrel. The higher average OPEX per BOE achieved in the Anasuria cluster for the current quarter of $24.18 was due to a combination of higher expenditure incurred for the various maintenance-related projects coupled with the strengthening of the GBP. Moving to the Peninsula Hibiscus Group assets, these include the 2012 Kinabalu Oil PSC, PM3 CAA PSC, PM305 PSC, PM314 PSC and Block 46 PSC. The Kinabalu and PM3 CAA assets are the largest contributors to the Peninsula Hibiscus Group's performance. For the Kinabalu asset, average net oil production in the current quarter fell compared to the preceding quarter due to the unavailability of the high-pressure gas compressor, resulting in insufficient gas lift supply to the oil wells. The compressor is expected to be fixed by early June 2023. Kinabalu's average net oil production of 2,343 barrels per day accounted for roughly 39% of Peninsula Hibiscus Group's total average net oil and condensate production of 5,975 barrels per day. One crude oil offtake was conducted in the current quarter with approximately 312,000 barrels of oil sold, representing 51% of the Peninsula Hibiscus Group's total oil and condensate sold. At PM3CAA, both average net oil and condensate production as well as gas production were higher in the current quarter due to achieving first oil from the Bunga Orchid C29 well, the longest well drill in Malaysia, as mentioned in the key messages by Pascal. Better performance from PM3 Northern Field Gas Injection Compressor supplying gas lift to the oil producers and continued uplift in production from H4 reservoirs through optimized water injection also contributed to the improved production figures. PM3CA's average net oil production of 3,344 barrels per day accounted for approximately 56% of Peninsula Hibiscus Group's total average net oil and condensate production of 5,975 barrels per day. Average net gas sale production increased to 7,836 BOE per day in the current quarter and accounts for all of Peninsula Hibiscus Group's gas production. Approximately 284,000 barrels of oil were sold, representing 47% of Peninsula Hibiscus Group's total oil and condensate sold, while a total of about 4,200 million standard cubic feet of gas was sold.
Hi, I'm CY, the Chief Financial Officer of Hibiscus Petroleum Group. I'll now take you through an overview of this quarter's financial updates. As often reiterated in the past, the group practices careful management of costs and the efficient delivery of production enhancement projects. This continues to be a critical part of our strategy of maintaining a low unit production cost structure in all of our producing assets. We also try to schedule the implementation of maintenance activities to ensure that positive cash flows are consistently delivered. The group operates or jointly operates its main producing assets, and this is a key enabler in allowing us to influence the timing of the implementation of operational activities and the supporting of our ability to manage the phasing of expenditure. The charts on this slide show the quarterly average realized oil prices, unit production costs, and EBITDA margins for both the Anasuria cluster and North Sabah over the last 10 quarters. For the Peninsula Hibiscus Group assets, The chart shows the weighted average realized prices of both oil and condensate offtakes and gas sales, unit production costs, and EBITDA margins over the last 5 quarters. As clearly shown in the charts, the average unit production cost for the Peninsular Hibiscus Group assets, North Sabah, and the Anasura cluster have been consistently well below the average realized oil price achieved in the respective quarters, delivering sustained positive cash flows. Management's focus remains on continuing this trend of overall performance. I would like to highlight that the group's revenue is almost fully transacted in US dollars, while costs are mainly denominated in the local currencies of the jurisdictions in which the operating assets are located, namely the Malaysian ringgit in Malaysia and the British pound in the UK. In addition to that, some costs are denominated in US dollars. Accordingly, a healthy US dollar bodes well for the group and positively impacts our cash flow and financial performance. The group's financial performance in the current quarter was delivered on the back of good operational performance in most of its producing assets. The group recorded a revenue of 523.3 million ringgit for the current quarter. Via its producing assets, the group sold approximately 1.1 million barrels of crude oil and 0.7 million barrels of oil equivalent gas. The sale of oil and condensate contributed 412.9 million ringgit to total revenue, while contribution from the sale of gas was 107.4 million ringgit. The relatively good operational performance has been a significant driver of our business performance, allowing the group to report an EBITDA of 291.6 million ringgit and an EBITDA margin of 55.7% for the current quarter. The Peninsular Hibiscus Group assets continue to contribute positively to the financial performance of the group. During the current quarter, this Peninsular Hibiscus Group assets contributed 327.9 million ringgit, or 62.7%, to the group's revenue, 200.1 million ringgit, or 68.6%, to the group's EBITDA, and 71 million ringgit, or 99.3%, to the group's PAT. I will now highlight the financial performance of the two notable production sharing contracts in the Peninsular Hibiscus Group assets, namely the PM3 CAA PSC and the Kinabalu PSC. The production level in PM3 CAA was enhanced by additional production from the BOC 29 ST1 well when it achieved first oil in March 2023, as well as increased contribution from the H4 reservoirs through optimized water injection. Furthermore, there was improved performance from the PM3 Northern Field gas injection compressor, supplying gas lift to the oil producers. Oil and gas revenue from the PM3 CA PSC achieved in the current quarter amounted to 108.3 million ringgit and 90.6 million ringgit respectively, from the sale of 284,000 barrels of oil and condensate at an average oil price of $87.03 per barrel and 705,000 barrels of oil equivalent gas. In the current quarter, PM3 CAA achieved a strong gross profit of 150.8 million ringgit and a gross profit margin of 75.8%. The EBITDA for PM3 CAA was 135 million ringgit, which resulted in an EBITDA margin of 67.9%. PM3 CAA achieved an average uptime of 92% and a high average net oil equivalent production rate of 11,180 barrels of oil equivalent per day, while a low OPEX per barrel of oil equivalent of $950 was recorded. The second notable production sharing contract in the Peninsular Hibiscus Group assets is the Kinabalu PSC. This PSC sold 312,000 barrels of crude oil net to our group at an average oil price of $91.49 per barrel. Kinabalu achieved gross profit of 81.3 million ringgit and a relatively high gross profit margin of 65.1% in the current quarter. Kinabalu's EBITDA for the current quarter amounted to 62.8 million ringgit. The EBITDA margin over revenue of 124.9 million ringgit was 50.3%. The relatively high profitability level was due to the high average realized oil price achieved. The average OPEX per barrel of $14.14 and average net oil production rate of 2,343 barrels per day have incorporated the impact of outages experienced with a high-pressure gas compressor that resulted in insufficient gas lift supplied to the oil wells.
I would like to highlight that while the Kinabalu PSC was in a taxable position in the current quarter, no provision for taxation was made, as there were sufficient historical tax losses brought forward to completely offset such taxes payable under the Petroleum Income Tax Act 1967 or PITA. Moving on to the North Sabah asset, this segment recorded revenue and gross profit of 107.5 million ringgit and 70.3 million ringgit respectively. The asset sold 300,000 barrels of crude oil net to the group. North Sabah operated in stable operating conditions in the current quarter and managed to report the lowest quarterly average OPEX per barrel thus far for the current financial year at $15.70. The average uptime achieved in the current quarter was high at 95%, while the average net oil production rate was 4,704 barrels per day. North Sabah reported an EBITDA margin of 45 million ringgit and 41.8% respectively for the current quarter. As for the Anasuria cluster in the UK, operational performance for the asset improved significantly since the project to replace the riser, which malfunctioned in May 2021, was completed in September 2022. During the current quarter, the asset recorded high average uptime and average daily oil equivalent production rate of 96% and 2,699 barrels of oil equivalent per day, respectively. OPEX per barrel of oil equivalent of $24.28 was, however, slightly higher as additional costs were incurred for maintenance work on the turret winch and for engineering feasibility studies conducted on the Anasuria FPSO. The UK segment's EBITDA recorded in the current quarter stood at 60.9 million ringgit. The UK upstream oil and gas industry is now subjected to an extra 35% tax on UK oil and gas profits, in addition to the existing ring-fence corporation tax of 30% and supplementary charge of 10%, for a total of 75% with the implementation of Energy Profits Levy or EPL recently. It should be noted that we do not expect a significant income taxation liability arising from the EPL regime. Our intention remains to phase our UK capital expenditure program such that we optimize the incentives offered as part of the EPL being imposed. It is also clear that the government is incentivizing decarbonisation initiatives within the UK oil and gas sector, and this encourages us to identify further opportunities that will reduce our overall carbon footprint. Lastly, the group remains in a strong liquidity position, recorded a net current assets of 296.4 million ringgit as at 31st March 2023. The improved financial performance and positive cash flows from our producing assets have contributed to this positive turnaround. At this stage, I will provide some insights into the group's current quarter's financial performance when compared to what was reported for the preceding quarter ended 31st December 2022. The group recorded an EBITDA of 291.6 million ringgit compared to 353.3 million ringgit in the preceding quarter, lower by 61.7 million ringgit or 17%. The PBT in the current quarter of 150.2 million ringgit was also lower when compared against the preceding quarter's 208.7 million ringgit. This was mainly due to lower volume of oil and condensate sold and lower average realized selling prices achieved in the current quarter. A total of 1.1 million barrels of oil and condensate was sold in the current quarter, lower than the 1.3 million barrels of oil and condensate sold in the preceding quarter. This was partly offset by the higher volume of gas sold in the current quarter at 4,388 million scf compared to 3,938 million scf in the preceding quarter. Accordingly, the group reported a lower revenue of 523.3 million ringgit when compared to the preceding quarter's 713.1 million ringgit. When compared against the preceding quarter, the group's total production in the current quarter was boosted by the PM3 CAA PSC. There was positive contribution from several areas. Firstly, from the BOC-29 ST1 well, subsequent to first oil being achieved in March 2023. In addition, there was an improved performance of the PM3 Northern Field Gas Injection Compressor, supplying gas lift to the oil producers, and increased contribution from the H4 reservoirs through optimized water injection. The Anasuria cluster in the UK also delivered favourable production matrices in the current quarter, following the completion of the riser replacement project in September 2022, to replace the riser which malfunctioned in May 2021. The group's average net oil, condensate and gas production rate achieved for the current quarter of 21,214 barrels of oil equivalent per day was higher than that recorded in the preceding quarter of 20,645 barrels of oil equivalent per day. From tax perspective, there were significant tax adjustments in both the UK and Malaysian operations in the preceding quarter, which did not recur in the current quarter. To recap, the preceding quarter's results after taxation had been heavily impacted by the effects of incorporating the non-cash effects of the new EPL regime up to 31st December 2022, as dictated by the relevant UK laws and accounting standards requirements. The resulting outcome was a significant one-off deferred tax liability charge in the preceding quarter of 106.7 million ringgit. This liability was non-cash in nature and will be gradually but fully reversed during the window for which the EPL regime applies, up to 31st March 2028. Secondly, during the preceding quarter, the group's subsidiaries, HML and Hibiscus Oil and Gas Malaysia PM3 Limited, reversed an old provision of taxes and related penalties relating to PITA and the Corporate Income Tax Act 1967, which amounted to 67.5 million ringgit. This adjustment followed a reassessment of the related provisions after the completion of tax audits for certain years of assessments. I'll now hand over back to Deepak, who will go over the offtake schedule.
Hello again. This slide presents the group's financial year to date oil and condensate offtakes and gas sales from our producing assets, together with the latest estimates for the financial quarter ending 30th of June 2023. It also includes data for the financial quarter ending 30th of September 2023. In summary, we estimate to sell a total of approximately 1.8 million barrels of oil equivalent and 2.1 million barrel of oil equivalent of oil, condensate and gas respectively net to the group. For the financial year ending 30th of June 2023, the group is targeting to sell a total of approximately 7.2 million barrels of oil equivalent of oil, condensate and gas. I will now hand over back to Andrew.
Thank you, Deepak. And that is all we have for this quarter's earnings webcast. Thank you for tuning in.